As we discussed in the first part of Chapter 3, we can use cost volume profit analysis to determine how hard a firm has to work just to break even. In this section, we'll use the same basic technique to determine how hard the firm has to work in order to achieve a certain desired target profit. To do this, we're going to use the same basic formulas that we used before. The only difference is, instead of setting profit to 0 as we would for break even, we can now choose a particular profit level. So our basic formula is that our profit is the contribution margin per unit times X, the number of units, and then minus the fixed cost. So we can use algebra to rearrange the terms of this equation and say that the profit plus the fixed cost must be covered by the total contribution margin, which is the contribution margin per unit times X, the number of units. Now, all we have to do is divide both sides of the equation by the contribution margin, and that gives us a handy formula for determining the target profit in units. That is, target profit plus the fixed cost is everything we have to cover with contribution margins. If we divide that amount by the contribution margin per unit, that will tell us how many units we need to sell in order to generate enough contribution margins to cover the fixed cost and give us the profit that we seek. If we want to find target profit in terms of sales dollars, we actually get two choices. One way is to use the contribution margin ratio. We can take the profit that we want plus the fixed costs that we have to cover and divide by the contribution margin ratio. And that will automatically tell us how much sales revenue we need to generate in order to cover both the fixed cost and the desired profit that we seek. Alternatively, we can take the number of units that we already determined and multiply it by the selling price. The way that's most convenient to do this really depends on the way that the data is presented. So let's take a look at Dave's Donuts, the same company that we used in Part A. If Dave wants to make a target profit of $1,800, how many donuts does he have to sell? Well, we start out with our formula, profit plus fixed cost divided by contribution margin will give us how many units we have to sell. Now we just have to fill in the data. In this case, Dave wants $1,800 of target profit, and he has $1,500 of fixed costs. He has to sell enough donuts to cover both of those at a contribution margin of 24 cents each. That is 60 cents sales revenue minus 36 cents of variable costs. He needs to sell 13,750 units. If he sells that many donuts and each donut provides 24 cents of contribution margin after it's already covered its own variable costs, he will end up with just enough to cover both his fixed cost and give him his desired profit. Now, what if Dave wanted his answer in sales revenue instead of in number of donuts? In that case, he could take his fixed cost plus his desired profit and divide by the contribution margin ratio. In that case, his contribution margin ratio was 40%. Divide that into the sum of his desired profit and his fixed cost, and we get $8,250. In other words, it will be just enough to cover his fixed cost and give him his desired profit. Conceptually, in cost volume profit analysis, desired profit is really just one more fixed cost that must be covered. To look at this another way, Dave could take his number of units that he has to sell, 13,750, and multiply by the selling price per unit, 60 cents each. And that will also give him his desired revenues to get his desired profit. And of course, these two methods will always give you the same answer. Another useful concept is margin of safety. Basically, that means how far away are we from break even? To put it another way, how much could our sales decrease before we have to worry about not breaking even? So, the formula for the margin of safety is the difference between the actual units that we sold, or it could be the number of units that we expect to sell, and break even in units. Another way to look at it is the difference between the actual revenue or the expected revenue and break even in sales dollars. Another way to look at it is with the margin of safety ratio, which is the margin of safety divided by the actual level. In other words, by what percentage could our sales decrease before we have to worry about not breaking even? So, for example, we already figured out in the previous section that break even for Dave's Donuts is 6,250 units. What if the firm actually sold 7,812 units during the period? In that case, the margin of safety is the difference between what they actually sold and their break-even amount. In other words, Dave's sales could decrease by 1,562 donuts before Dave had to start worrying about not breaking even. Alternatively, the margin of safety ratio is the margin of safety divided by the actual number of units sold. In this case, the margin of safety ratio is 20%. Sales can decrease by 20% before Dave has to start worrying.